Today I'm going to focus on the two scenarios that I finished with last time. One was inflation and the other was a crash, and what to do about them. And so I'm going to recap the two scenarios, then explain why I think the nominal interest rate is going to rise and why at the same time the real interest rate might not rise. Then I'm going to go over typical inflation hedges and whether they are crash-proof or not, and go over Michael Burry's rumored investments and how they may play together. And finally, I'm going to offer some possible tweaks to those investments. And so the two probable scenarios that I finished with last time, the first one is high inflation with lowish rates that I'm going to explain in a minute. And in that scenario, we have an extension of the current bubbles in real estate and especially in stocks. The other scenario is that the bubbles pop, and that might happen due to higher real interest rates, a crash in Chinese real estate, a conflict in Iran, in Ukraine, and finally a green inflation, which is the forced transition to green energy sources. And the last three causes basically cause an energy shock. And typically in an energy shock, when the cost of energy rises, that causes a recession. And so in order to understand the issue of real interest rate, let's first define the real interest rate as the interest net of inflation. And so what we have here on the y-axis is the nominal interest rate for a 10-year loan. And on the x-axis we have inflation. And our starting point is very low nominal interest rate, but fairly high inflation, which is where we are right now. And so the scenario that I am describing is that we have a fairly sharp increase in nominal interest rate, but in addition, we also have an increase in inflation. So why do I assume that the nominal interest rate would rise? We have a Federal Reserve in the US that already announced that they are reducing the amount of lending that they're going to do going forward. And at the same time, we have the government or the Treasury that is planning to borrow even more. And so if we're describing the market for loans, the price of those loans is the interest rate, and that's on the y-axis, and on the x-axis we have the amount of lending. And we have a supply curve, which is the Fed plus other central banks and other players, including consumers and investors and so on, who are lending to the government. And we have a demand that is coming from the government or from the Treasury. And as I said, the supply is going to shift to the left because the Federal Reserve already announced that they're going to reduce the lending. And at the same time, the government or the Treasury is going to demand more lending. And as a result of that, we have a shift and an increase in the interest rate. So that's the basis of my assumption. In addition to that, we have different interest rates for different durations of loans. So we have interest rates for short-term loans, 10-year loans, 30-year loans, and typically as the loan is longer, the interest rate is higher. And so now that the Federal Reserve tells us that they're going to lend less, but also that they're going to keep the short-term rates low, they have less ammunition and that would require that they focus their lending in the short-term market in order to keep the interest rates low there. And that would force the Fed to do less of a suppression of interest rates in the longer duration loans. And so what happens to the real interest rate is another matter. So the real interest rate is the interest, the nominal one, net of inflation. And here we start from actually a negative real interest. So we at the moment have a very low nominal interest and the fairly high inflation, which causes the real interest to be negative. So basically at this point, people are paying the government in order to lend the government money, which is it's not usually a situation that can last too long. And the two possibilities or the two directions that we can continue from here is that the nominal interest rate rises, but inflation rises as well. And so in that scenario, we have basically a fixed real interest rate. There's no change to the real interest rate, despite the fact that nominal interest rates are rising. And in that scenario, the bubble typically continues to inflate. The other scenario is where we have a increase in nominal interest rate, which is higher than or faster than the increase in inflation. And in that case, the real interest rate becomes positive, and that at some point could lead to bubble popping, and eventually when that happens, the nominal interest rate is reduced again. And that will become relevant when we talk about different assets. And so if we look at the typical inflation hedges, those are typically gold and silver, energy commodities, agricultural commodities, real estate, stocks, and more recently, Bitcoin. And typically in an inflationary situation, bonds do not do well because of the negative real interest rate, as we saw. And so the next question is whether these assets are cheap right now, whether they are kind of crash resistant, because if they are already very expensive, then they might depreciate a lot if there's an asset crash. And so gold and silver are relatively still cheap relative to other assets. Energy is not cheap anymore. The prices of oil and gas rose very quickly in the last year or so. Agricultural commodities are still relatively cheap. Real estate is not, but still relatively to stocks, real estate is still much cheaper than stocks. So stocks are I'll show you the graphs, is completely in the stratosphere, and so is Bitcoin. And so this is the chart of the ratio of the prices of stocks to real estate. And we can see here that the ratio is even higher than in the dot-com bubble. And so stocks are much more expensive than real estate. And in this chart, we can see the ratio of stocks to GDP, basically to the US economy, the US stocks to US economy. And we can see that we are in an unprecedented bubble. And so there were rumors recently on YouTube and other places about what Michael Burry is doing about the current situation. And if you don't know the name, he's the guy from The Big Short, who bet against the real estate market in 2006 or so. And so what he's been doing is investing in defensive stocks. Those are stocks that have profits right now, not in 20 years, and also have pricing power. So if there is inflation, they can increase the prices and continue to be profitable. The other thing that he's been rumored to do is to short treasuries, and that's because higher nominal rates are basically equal to lower prices of treasuries. Then he also been said to short Cathy Wood's disruptive technology fund, which is made of speculative companies that are growth companies that plan to have profits only years and years down the line. And when you have a very low interest rate like now, the discounting of these very far out in the future profits causes the profits in the future to be almost equal to profits today. But when interest rates, and especially real interest rates, go higher, what happens is that the discounting kicks in, and suddenly these way out in the future profits, let's say $1 in 20 years, become let's say 10 cents today, and that causes the valuation of these companies to sink. And so this is another thing that he's been rumored to do. And last, he was short Tesla. I think he's not short Tesla anymore, and that's probably a bet against the green inflation that I'm gonna talk a little bit more about next. But first, I think that one thing that perhaps was missed about the combination of treasuries and disruptive technologies is typically people know that if you combine treasuries, when you invest in treasuries and in stocks, these cause kind of a shock absorbing mechanism, because typically when stocks go up, the treasuries go down, and vice versa. So you have this natural balancing mechanism, and I think that the combination here on the short side is doing something similar. The thing that I kind of wonder if there might be a possibility for improvement on this is that if there is a crash, typically the price of treasuries goes up. And so in the next video, I'm going to propose another alternative,